Long-term investing or long-term stubbornness? In investing, the mantra, think long-term, is repeated constantly. While patience and time in the market are key to compounding wealth, there is a subtle but critical distinction. Holding for the long term is not the same as holding out of stubbornness. 1. The value of true long-term investing. Long-term investing is a deliberate strategy. Focus on fundamentally strong assets. Understand the business, market, or instrument. Accept short-term volatility for long-term growth. Follow a disciplined plan. Warren Buffett emphasizes that holding quality investments over decades works when the thesis is sound, not merely because time passes. 2. The danger of long-term stubbornness. Stubbornness occurs when investors hold positions despite evidence that circumstances have changed. Ignoring deteriorating fundamentals. Refusing to cut losses. Letting ego dictate decisions. Believing that it must come back eventually. Behavioral finance shows that sunk cost fallacy and loss aversion fuel long-term stubbornness, turning patience into a liability. 3. The psychological trap. Investors often confuse discipline with stubbornness. Discipline, based on analysis, rules, and conviction. Stubbornness, based on pride, denial, or hope. Daniel Kahneman explains that human cognition tends to overweight previous decisions. Time alone does not validate a choice. 4. Opportunity cost of stubbornness. By holding failing positions, capital is locked and cannot pursue better opportunities. Emotional stress increases. Portfolio performance suffers. Compounding is interrupted. True long-term investing reallocates when necessary. Stubbornness ignores alternatives. 5. How to differentiate. Indicators that patience is productive versus destructive. Patience, virtue, thesis remains strong. Market volatility only. Periodic review and adaptation. Adjust allocations if needed. Stubbornness, risk, thesis deteriorates. Fundamentals worsen. Blind holding. Refusal to change. 6. Practical approach. Regularly evaluate investments. Define exit criteria and limits. Avoid letting pride or fear dictate decisions. Understand that long-term is a horizon, not a justification. Howard Marks notes, the best investors know when to act and when to hold, not just how long to wait. Conclusion. Time in the market can create wealth, but time in a position does not guarantee success. The difference between long-term investing and long-term stubbornness is discipline, analysis, and adaptability. Key insight: patience compounds wealth. Stubbornness compounds mistakes.